Hey, today I want to talk about making extra payments on your mortgage in order to pay your house off early. A lot of people over the course of my 24-year career, I've seen a lot of people that are very concerned about getting their mortgage paid off. So they pay extra on their mortgage because they're afraid of having a mortgage. They're afraid of having that payment. They want to pay extra, get it paid off. But let's look at what's happening when we make extra payments on our mortgages. You've got to consider what the interest rate is. I looked up today, and today is November 3rd, 2021. I looked on bankrate.com. What is the interest rate on a 30-year fixed mortgage? Well, I was seeing less than 3%, so 2.75%, but let's just call it 3, okay? Let's say it costs you 3% to get a mortgage today. And for purposes of my illustration, let's use my mortgage interest rate, which I got a mortgage a few years ago. It was 3.99% or 4%, okay? So let's say you have a mortgage, it cost you 4%. So I'm gonna cover up half of my illustration here. If you pay extra on that mortgage, you see I got the dollar sign pointing into the house, you pay extra on that mortgage, you're saving yourself interest in the amount of 4% or whatever your mortgage interest rate is. That is the effect of those extra payments. Okay, that's a good thing. Nothing wrong with that. But you're saving yourself interest in the amount of 4%. Now, if your mortgage interest is tax deductible, you need to take that into account. Because when you pay mortgage interest, it may cost you 4%. But if you're getting a tax savings from the mortgage interest, well, then the true net out-of-pocket cost to you is actually less than 4% because I'm paying 4%, but I'm getting a tax savings. So my mortgage may cost less than 4%. But let's throw the tax savings out for a minute and let's just focus on that interest rate, okay? If I pay extra on the mortgage, I save myself interest in the amount of 4%. What if I took that extra payment every month and instead of putting it into the mortgage, what if I invested it instead? So I looked up the Franklin S&P 500 Index Fund, and again, November 3rd, 2021, and I looked at the 10-year return and the 15-year return on this fund. So the 10-year return was 15.77%. That's pretty good. The 15-year return was lower. It was 10.12%. So think about it. I could pay extra on my mortgage and save myself 4%, or over the last 10 years or 15 years, I could have paid into this Franklin fund and I could have earned 10%. So I've got a mortgage costing me 4, but I'm investing and I'm earning 10. That's called arbitrage, folks. Having a loan, borrowing money at a low interest rate, and then being able to therefore invest money at a higher interest rate. It's called arbitrage. That's what the banks and credit unions do. That is their business model. They borrow money from depositors. They pay a low interest rate to depositors on their savings account. They borrow money from them. Then they take that money and invest it. They lend it out. They take risk and they earn a higher interest rate on those loans than what they pay to get the money. It's called arbitrage. They make the difference. We could do the same thing too. So for my illustration, and I know this fund did 10.12% over the last 15 years, but for my illustration, what if I invested my money and I only earned 6%, okay? So my mortgage costs me 4%, but I'm investing extra payments and I receive 6%. Okay, I'm still ahead of the game, okay? I could grow money in that fund. And couldn't I still decide in the future at some point if I wanted to pay my mortgage off early? Couldn't I withdraw it from the fund maybe in 10, 15 years and pay down principal on that mortgage? Pay it off or pay it down significantly? Couldn't I do that? Sure. I could still get the mortgage paid off early. I've just chosen a different route to get there. And the beauty of this route is that in the meantime, if I ever have an emergency, you see that arrow coming back to me? If I ever have an emergency and I've got my money sitting in an account somewhere, I have immediate access to the money. Now, the money's in an investment and it could be a less than ideal time to withdraw from the investment if the investment's down in value. But the point is I have an account that I can access. If all of my wealth is locked up in my home equity, folks, that's a problem, because if I lose my job and I'm unemployed and I need to get that home equity, guess what? The lenders, the banks, they don't want to lend money to a person who's unemployed because they don't have the ability to repay it. So this feeling of safety that people get when they're paying toward their mortgage and paying off their mortgage early, it's not necessarily a real thing. You're not necessarily safer. You could be jeopardizing your financial position if you don't have substantial liquid savings and investments. So it's not just about earning a rate of return or getting the most effective use of your dollar, because that does matter. The numbers matter in terms of building net worth. I want to get the most efficient and effective use of my money, but it's also having access to my money when I need it in an emergency. Hope this has been helpful. This is why I have never paid extra on a mortgage in my life. And of course, if mortgage interest rates were 10%, I might be having a different conversation. But as long as I've been in this business, mortgage rates have been 4, 5, 6%, okay? Being afraid of a mortgage, in my opinion, is not the thing to do. Be afraid of credit card debt. That's what you want to be afraid of. 23% interest. That's a problem. Hope this has been helpful. See you in the next video.